Hi, everyone. I'm Mike Pacito with I Am Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for watching our year-end 2025 review video on the I Am Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. Well, there's a lot to say about 2025 as it relates to managed futures, and a lot of things happened in the space this past year. The big brand firms entered the arena with Fidelity, BlackRock, and Invesco all launching their own ETF vehicles. Dispersion between managers was wider than ever, and DBMF, with its efficient, institutionally oriented index plus replication approach, saw strong adoption, crossing $2 billion in assets. Thanks to all of you who have been part of this success and our mutual goal of making managed futures and liquid alternatives the best they can be for investors. So let's dive deeper into all that and more to include DBMF's annual absolute and relative performance, attribution, and positioning for the year that was 2025. Over to you, Andrew.
Thanks, Mike. Well, what a year. So the best thing for most investors was to unplug a year ago and check back in today. Your equities are up, your bonds are up, your alts are up, and if you were lucky enough to own some gold, you've had windfall profits. Of course, it didn't feel like that throughout the year. A global trade war, an attack on the independence of the Fed, a brief period where DeepSeek made US AI investment look like a costly mistake, unbridled industrial policy, and more than a few geopolitical brushfires. And this is the point we've been making in these videos all year long, which is that basically 2025 was all about noise, where the most powerful man in the world is a human noise generation machine. But macro information didn't change that much. No tariff-induced recession, no reignition of inflation, no bond market tantrum, no wholesale devaluation of the dollar. And that kind of environment is really not great for most CTAs. Remember, CTAs generate most alpha during regime shifts, not the noisy status quo. Hence, for many managers, it made 2025 into something of whipsaw hell, especially given how sensitive shorter-term models and risk controls are to the latest tweet and or gap up or down in a given market. And yet, it was a historically good year for replication. As you see on the left, we're up around 1% in December, in line with the SocGen CTA index, and somewhat behind the Morningstar systematic trend category. Now, year to date, however, we were up nearly 14%, while hedge funds were flattish, and the Morningstar category is up between 2 and 3%. Now, as we said in the third bullet point, the replication debate, that is, whether replication is a cheap knockoff or technological innovation, really is over. It seems quite clear that we developed a way to extract the alpha of the space much more efficiently while avoiding some model decisions that, in fact, cost investors last year. And the key alpha generator of 2025 was to bet that things were not as bad as the noise made them appear, which meant major markets trended nicely as the dust cleared and reducing to the extent possible the cost of head fakes from unstable market sentiment. More on this in a few.
So, taking the wheel back here, Andrew, on the topic of noise, behind that low single-digit return number average that you just mentioned for the Morningstar category, there was a lot of performance variance going on in the background of managed futures land between managers and strategies. So, what you're looking at here is DBMF's 2025 annual performance versus the ETF peer group median, the mutual fund peer group median, and the SocGen CTA index. On the left is the best performer in the Morningstar category, which, for compliance reasons, will go unnamed. And on the right, for the same reasons unnamed, that's the bottom performer. Besides the fact that DBMF did very well last year in absolute and relative terms, there are really two big stories here. The first is that the spread between the top and bottom performer for 2025 in the systematic trend category was over 36%. So just imagine that kind of dispersion in any other typical asset class like large cap stocks or high yield bonds. The second is that ETFs outperformed mutual funds and the index. This is shaping up to be a game changer in the managed futures product business in that investors are using ETFs, which tend to be simpler in portfolio construction, to access the space and get more efficient results alongside full transparency and liquidity. For a little bit more detail on this, we refer you back to the Hedge Nordic article Andrew wrote called The Awkward Problem with Managed Futures ETFs. It's linked in the email that accompanies this month's video delivery. So, zooming out over a longer time period, this chart goes back to when DBMF incepted. You'll see that DBMF outperformed the fund peer group, the CTA index, and the ETF peer group. There were only two other live ETFs at this time, That is when DBMF incepted, so the ETF peer group average isn't too statistically valuable. But either way, all of these comps performed quite close to each other. But this emphasizes our key point that our clients know really well. DBMF, by maintaining high correlation to the category via the SocGen CTA index, but being very efficient by extracting explicit fees, that would be the expense ratio, and implicit fees, that would be trading costs, while avoiding the single manager dispersion that you just saw, results in a highly effective solution.
So to add what Mike just showed you, here's our performance since the launch of DBM for 2019. In part because of such strong outperformance last year, we've now added more than 350 basis points of returns per annum relative to the SocGen CT index and with more than double the Sharpe ratio and a correlation approaching 0.9. Now, back to the point I made earlier about the quote replication debate unquote being over. On virtually every statistical measure over not just past the 6.5 years since the launch of DBMF, but 9.5 years since inception of the strategy itself, investors would have been better off replicating hedge funds rather than investing in hedge funds, and for that matter, mutual funds. Yet every year we hear arguments about how this year will be the year where hedge funds will outperform net of fees, expenses, etc. Of course, there will be periods like this when this will be the case, like 2023, but I think that we've shown conclusively that the odds are very much against it. So rather than build a cheap imitation of hedge funds, we've shown that the true signal of CTAs, major market moves, primarily driven during regime shifts, can and should be harnessed in the most efficient way possible. So here's our slide on volatility adjusted positioning. The green bars are the volatility adjusted exposure of our 10 futures contracts at the end of December, and the red dots are positioning as of the end of September. Moving from left to right in commodities, we were long oil at the end of Q3, but are now essentially flat. We remain long gold and have been for quite a while as the trend shows no sign of tiring. Ray Dalio and Nassim Taleb may be onto something there. In currencies, we've maintained roughly the same sizable short yen long dollar position that we had on the end of Q3 2025, but we've simultaneously are now almost equally long the euro versus the dollar, which makes for a very interesting currency pair trade of sorts. In bonds, we're somewhat short rates, but not on the long end of the curve, with the belief that rates will come down and the curve will steepen. And in equities, we're modestly long globally with a heavier weighting toward EFA than the US or emerging markets. Now, finally, here's 2025 overall contribution to performance. The top three positive contributors were gold, not surprisingly, global equities, and the yen short. On the negative side was the euro, alongside bonds and rates. But in summary, 2025 was an excellent absolute return and relative year for DBMF. And with that, back to you, Mike.
Okay, thanks, Andrew. So let's wrap up here, as we always do, with long-term performance numbers for DBMF. Annualized return since inception, including the year that was 2025, is now 8.26%. That's ahead of the SocGen CTA index by over 380 basis points annualized, and it's ahead of the Morningstar systematic trend category average by over 470 basis points. And long-term outperformance against the traditional diversifier for equities, that would be bonds, as represented by the Bloomberg AG, is well intact. DBMF outperforming by over 660 basis points annualized. So thanks to our clients for an excellent 2025, and to our prospective clients, we hope you'll join us as full-fledged clients in 2026. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.